Hello and welcome back to the Geordie Pig Investor channel. Today we're diving into a brand new type of investment product that's been making waves in the market known as IncomeShares ETPs. I've had quite a few requests to do an in-depth analysis on this, as I know a lot of you are unfamiliar with how they work. So if you've been hearing the buzz and wondering what they are, how they work, and whether they might fit your own personal portfolio, then you're in the right place. We're going to break it all down in simple terms: what sets IncomeShares apart, how they generate income, and the risks you need to know whether you're a passive income enthusiast or just looking to diversify your investments. This could be a game changer. Let's get straight into it. An IncomeShares ETP exchange-traded product is a type of financial instrument that provides investors with regular income payments, typically derived from the dividends or interest generated by the underlying assets. IncomeShares ETPs became available on the UK market last year in July, and one thing that's very exciting about these are that they are listed on the London Stock Exchange, so all dividends received are tax-free if you are to hold them within an ISA. So if you are a UK investor watching this video, I beg you that you do open up a stocks and shares ISA and you make sure that you max out your £20,000 yearly allowance before you are to put any money in some general investing account, as you could be saving thousands of pounds a year with it being held in an ISA account, as it is all tax free. What makes IncomeShares ETPs so special? Well, they are structured specifically to deliver income, and in this case will pay you out on a monthly basis. The underlying assets are typically income generating. The ETP distributes the income from these assets directly to investors as dividends or interest payments. There are two types of IncomeShares ETPs, and in today's video we are going to look at one of them. The one we're going to look at is the covered call strategy. If you want to see another video where I cover the other option, known as the 0 days to expiry strategy, in more detail, then please let me know in the comment section down below. So getting back to the covered call strategy, this option strategy is where you own a stock and then sell a call option on that same stock to earn extra income. When you sell the call, you're giving someone else the right to buy your stock at a specific price, called the strike price, before a certain date. In return, you get paid a premium. If the stock stays below the strike price, you keep both the premium and your stock. If the stock rises above the strike price, you still keep the premium, but the stock gets sold at that strike price, so you miss out on any gains above that level. Don't worry, if that didn't make any sense to you in the last slide, then I'm going to try and break it down further, so hopefully by the end of the video you'll have a better understanding. Let's start off by looking at what options are. Options are financial contracts that give you the right but not the obligation to buy or sell an asset, such as a stock, at a specific price. This is known as the strike price, like I mentioned in the previous slide, and it has to be done before a certain date. This certain date is known as the expiration date. There are two types of options. The first one is a call option, which lets you buy the asset, and the other one is a put option, which lets you sell the asset. Unlike buying stocks outright, options can cost much less upfront, but they also come with much more complexity and risk, especially as expiration approaches. Now we will have a closer look into the covered call strategies that are used within the IncomeShares ETPs. As you know, on my channel I'm always as transparent as possible, so I'm going to tell you right now that I have actually added two of these types of income shares into my own dividend portfolio recently. Hence why I actually had a few viewers commenting on my most recent uploads saying that they would quite like to see some more information around these ETPs, and that's why I have created this video today. So if you do enjoy the video, please let me know in the comment section down below, because it's greatly appreciated to hear all of your feedback. So what is a covered call strategy? Also known as a buy right strategy, a covered call is a two-part option strategy where you have a buy and a right, also known as the sell. They use a covered call strategy by first off buying shares of a stock. They then sell a call option contract at a strike price above the current price. They will collect the premium from selling the call, and from this there are two possible outcomes. If the stock stays below the strike price, they then keep the shares and the premium, or if the stock rises above the strike price, the shares are called away, aka sold, and you still keep the premium but you miss out on any gains above the strike price. Specifically in this scenario, the premium that is received from selling a covered call is kept as income, and by selling covered calls it can help target a sell price for the stock that is above the current price. It also has some downside protection from a premium that's already been received. If this is still a little puzzling to you, then don't worry, I'm going to show you all an example that will hopefully help it make more sense. I know that I sometimes understand things a lot better through visual learning. So hopefully this will simplify it down for you to see how these strategies are used within the IncomeShares ETPs. In our example, we have Michael and Jane. Just to keep it simple, let's say Tesla stock is currently $100 and Michael has a call option to sell. Jane is wanting to buy his call option at a $5 premium price per share for a strike price of $110. There are then three possible outcomes once this is agreed. In scenario 1, Tesla rises above $110. So in this scenario, Michael is obliged to sell Tesla at $110, which is now less than the market price, but further losses are offset from a $5 premium earned from the contract. In this scenario, Jane now has the option to purchase Michael's Tesla stock at $110, and with the stock being higher than that price now, she can pocket the profit. Ignore that it says John on the screen and don't get confused, that is supposed to say Michael. In scenario 2, Tesla stays at exactly $110. In this scenario, Michael retains the $5 premium regardless of whether Jane decides to purchase Michael's stock or not. For Jane, there are actually no incentives now for her to buy it from Michael, as the price would be the same for her on the open market. And finally, you have scenario 3. This is where Tesla falls below the $110. So in this case, Michael will keep his Tesla stock and the $5 premium. For Jane, it would make no sense to buy the option, as she could buy Tesla for cheaper on the open market. If I was to ask you which scenario is best for Michael, which one would you say? The answer is scenario 2. This is actually the best scenario for Michael. The reason it's the best one is because he keeps the $5 premium, which is profit, and he also keeps his Tesla shares, which are now worth $110. So he doesn't miss out on the upside since the stock didn't go above the strike, and there's no downside loss, unlike if the stock had dropped. I hope this now makes more sense to you. I do find it is very important for you to understand what you're investing in, hence why I'm breaking it down for you in today's video. And I think if you don't understand it after today's video, then you need to do some further research, because it's so important that before you make any investments, you should understand exactly what you're investing into. And that isn't just for these ETPs today, that should go for any company that you're looking to purchase, because if you don't understand what you're investing into, then you may as well go to the casino, put some money on red or black on the roulette table, and away you spin. What's the major downside to a covered call? The main downside is that the seller of a covered call forfeits the upside potential of their stock position in exchange for collecting upon selling the call options. It does depend how you look at it, as this could be seen as a good thing, as it reduces the downside potential too. Let's have a look at how a covered call may perform in different markets. So if it's a bull market, you will likely underperform the market, as they keep the option premium from the calls, but it's got a limited upside potential, meaning you will miss out on larger gains. In a bear market, you can expect to outperform the market as a whole, because the premiums you have received will limit the downside potential compared to the full hit you would take if you owned the stock. And finally, in a flat or choppy market, you will likely outperform the market again, as you will keep the premium from selling the call option. So as they are only really going sideways, you are seeing better returns. This backs up why scenario 2 was our best case earlier for Michael. When you own an ETP, each month you will receive a varying distribution amount. They don't just randomly pluck the distributing amount out of thin air like I think some people actually believe. It actually comes down to how volatile the commodity or market is. The higher the volatility, the higher the premiums will be. But this also means the downside potential is higher too. And just to show you the 3 different moneyness options, you have OTM out of the money, ATM at the money, and ITM in the money. Each have different premiums and for different reasonings. On screen are all of the different cover call ETPs that are on offer right now. You can see the distribution yield for each of the ETPs for this coming month in June, with them all having quite varying distribution yields. Some yields are as high as 89.9% with Coinbase Options ETP, but you also have some smaller yielding ones like Microsoft, Meta, and Amazon, being at 3.49%, 11.66%, and 12.16% for this coming month. The higher the yield, the more volatile the stock, which makes sense as we all know that Tesla is very volatile, and you can see they have a distribution yield this month at 83%. And then the one that we just mentioned being Coinbase, which has a distribution yield at 89.9%, and that is also a more volatile stock, with them being heavily linked to crypto. As I mentioned earlier in the video, I do own 2 of these income shares, and they are actually arguably the 2 most volatile ones. You guessed it. I own the Tesla Options ETP and the Coinbase Options ETP. The reason I've picked these is because currently they are only occupying a very small portion of my portfolio, so I don't mind taking a little bit more risk, especially receive some monster dividend payments. Then I can reinvest these monster dividend payments into my safer ETFs such as JGGI. Why I think you should consider IncomeShare ETPs. Well, first off, they are Europe's first option-based ETPs targeting individual assets, and as shown, they can offer some massive yields to kickstart or speed up your dividend snowball. They have very competitive expense ratios at just 0.55%, and they do offer that nice downside protection. Now, of course, the stock price will be volatile and you have to expect some NAV erosion, so you really do have to be comfortable with potentially seeing a lot of downside in the stock price and holding firm and riding out while picking up the dividend payments. If you don't like big price swings and higher volatility, then these definitely are not for you, so please bear that in mind. Also, remember that I am not a financial advisor, so I strongly recommend you go away and do your own thorough research before buying anything from the stock market. Past performance is no guarantee of future result, and your capital will be at risk. And that's a wrap on IncomeShare ETPs. Hopefully now you've got a clearer understanding of what they are, how they generate income, and whether they might fit into your own investing strategy. If you found this video helpful, give it a like, drop a comment with any questions, and don't forget to subscribe for more breakdowns like this one. Thanks for watching, keep compounding, and stay patient in the market because your future self will thank you. For now, this is the Geordie Pig Investor, over and out.